Hello, fellow compounders. Have you ever wondered how investors like Peter Lynch and Warren Buffett can get gains of 10 times to 100 times on their stocks? They do so by picking good stocks that can compound their earnings over a long time. The challenge is having the confidence and willpower to allow your stock's time to compound. In this video, I'll show you a trick to do so. Welcome to the Always Be Compounding Club, where we share ideas on how to build, grow, and enjoy wealth. I'm your host, Dennis Chen. I'm a full-time investor and CFA charter holder. Welcome aboard. So let's get started. In 1984, there was an article written by Robert Kirby in the Journal of Portfolio Management titled The Coffee Can Portfolio. Kirby was a financial advisor who was working with a client for about 10 years when the client's husband died suddenly. She inherited his estate and she called Kirby to add the securities that her husband was managing to the portfolio that Kirby was managing for her. Kirby found out something that gave him the idea for the coffee can portfolio. It turned out that the client's husband was piggybacking on Kirby's recommendations to his wife and buying the stocks Kirby suggested. He bought about $5,000 of each of the recommended stocks and placed stock certificates in a safe. And he never sold a stock. Remember, this was in the 1950s, so paper stock certificates were still in use. So, at his death, the resulting portfolio had a number of small holdings of less than $2,000 and several large holdings, each worth $100,000 or more. There was even one very large holding worth over $800,000, which by itself was more than the entire value of the wife's portfolio that Kirby was managing. That large holding started out as a small investment in a company called Haloid, which later turned into a zillion shares of Xerox. That's how the coffee can portfolio concept began. Kirby used the analogy of people in the Old West who kept their savings in a coffee can. Basically, the coffee can portfolio is a buy it and forget it approach. You look for stocks of businesses that have good underlying fundamentals that may be able to compound their earnings for many, many years. So you buy them and forget about them. Then check back after 10, 20, or 30 years. Warren Buffett uses a similar approach in Berkshire Hathaway's stock portfolio. Buffett said that his ideal investment holding period is forever. Many of Berkshire's stock investments have been in the portfolio for over 20 years. He even had a 100-bagger, that means he made 100 times his investment, that was in the portfolio for 40 years. Here's a sample of some of the Berkshire Hathaway's long-held positions. Keep in mind that we are only looking at the stock gains, excluding dividends. The returns are even higher if we included the dividends. So here they are. American Express was a position that was bought in 1991. Buffett invested $1,287 million or $1.2 or $1.3 billion. And at the end of 2021, that position, excluding the dividends that were paid, was worth $24.8 billion, about 19 times his investment in 31 years of holding it. Coca-Cola was bought between 1988 and 1989, and he invested $1.3 billion, and now, or actually at the end of 2021, that position is worth $23.7 billion, or 18 times the initial investment in 34 years. And remember, Coke pays dividends, so we're not even counting that. BYD was bought in 2008. This is one of the younger positions. He invested $232 million, and at the end of 2021, it was worth $7.7 billion, or 33 times the initial investment in 14 years. Moody's was bought in 2000 for $248 million, and it was worth, at the end of last year, $9.6 billion, or 39 times the initial investment in 22 years. And the 100-bagger was the Washington Post. Berkshire bought the position in the Washington Post for around $11 million in 1973. And in 2014, right before the Washington Post was sold to Jeff Bezos from Amazon, they were valued at $1.1 billion, which is a 100-bagger in about 40 years. The coffee can portfolio is a powerful concept that is very useful for individual investors. Most financial advisors tend to ignore it and don't talk much about it because it doesn't help their business. Imagine all their clients just buying and doing nothing for 20 or to 30 years. The client will probably ask, what is this advisor doing for me? Do I really need him? So most people or most advisors wouldn't talk about this. The coffee can approach is getting some traction in India. In 2018, Saurav Mukherjee, hopefully I pronounced it correctly, CEO of Ambit Capital and fellow CFA, wrote the book Coffee Can Investing. His firm follows this approach and has been successful. His book is probably worth reading. So, how can a coffee can approach help you become a millionaire? Coffee can investing is very easy to implement since it's a buy it and forget it approach. Just buy stock of good businesses with growing earnings and let them compound over time. Populate the portfolio and don't touch it for at least 10 years. Even better if you gave it 20 to 30 years to compound, just like a good wine or fine wine. Here are the advantages of coffee can investing. Number one, you'll make better investment choices. Since you're buying a business that you'll keep for at least 10 years, you'll put some reasonable effort into choosing your stocks, almost like choosing someone to get married with. Number two, it is tax efficient. Your capital gains tax will be zero until you sell. Number three, no trading costs. Since you will not be trading, your cost will also be zero. Number four, less anxiety. Since you know that you will not be selling for at least 10 years, you won't worry about the stock volatility. Number five, your stocks have the potential of becoming 10 to 100 baggers. So what are the disadvantages? Number one, you will need to have a lot of patience. And number two, you could lose it all if you only had one single position. However, we can mitigate the disadvantages. Number one, on patience and willpower, let's create a separate account and only put money that you won't need for 10 years and that wouldn't hurt you if you lose it all. You should not miss it or think about it for a long time. Number two, yes, you could lose it all if you have one single position. The solution is simple. Have several positions in the portfolio. There are no limitations on what you can put in your coffee can. So let's buy $1,000 of each of the 12 stocks, making an investment of $12,000. And let's assume that the initial average return of our picks is 6%. Let's say that we have 3 stocks that perform above the S&P 500 average, which is around 10%, among which we have a 25% compounder, which is our Michael Jordan or LeBron James of the portfolio. And stocks 4 and 5 are average, gaining the same as the S&P 500's 10%. Stocks 6, 7, 8, and 9 are below average performers. And to be conservative, let's say that stocks 10, 11, and 12 just lose money and are real duds. If we just didn't do anything to the portfolio and let the 12 stocks sit and compound, the $12,000 would grow to almost $994,000, close to $1 million at year 30. That is about 83 times the initial investment of $12,000 or a 15.9% average annual return. That's close to $1 million by just letting it compound in the coffee can. Remember that in this scenario, more than half of the portfolio underperformed. And also, you had 25% that lost almost everything. By having just one superstar position, it more than made up for the duds. The real power of the coffee can is having the patience to let your businesses compound over many years undisturbed. There is still the second part of the equations to deal with, which is selecting the right stocks to put in your coffee can. We will work on this in future videos. If you'd like to learn more, hit that like button and subscribe to the channel. Thanks for watching. See you in the next video, and remember to always be compounding. Take care.